Welcome to Him's House. I'm excited to share with you this conversation with former high-frequency trader Annanay Kapila. But first, let me tell you about Mochi Health. In 2026, you can get literally anything delivered to your door in under an hour. But if you want to see a specialist, you're booking 3 weeks out and waiting for hours in a waiting room, only to stand in another line at the pharmacy. Mochi Health fixes that. They've built a nationwide telehealth platform that operates across all 50 states, matching you with board-certified physicians who actually specialize in metabolic health. You get a real consultation and a personalized treatment plan that gets delivered straight to your door. We're talking about a platform that has already helped 400,000 members lose over 5 million pounds. And it's not just weight loss anymore. Mochi is now a full-scale healthcare marketplace that covers over 120 conditions from dermatology and hair loss to sleep apnea and mental health. For a limited time, you can get more than 50% off your first month of membership. Go to joinmochi.com. That's joinmochi.com. Take the 2-minute assessment, choose your doctor, and join the growing community now. Mochi, your health can't wait. And now here is my conversation with Annanay. Him's House, episode 57. My name is Jonathan Stern. I'm here today with Annanay Kapila, founder and CEO of QFEX, a 24/7 financial exchange, or as I saw one person describe it, FTX without the fraud. Annanay studied mathematics at the University of Cambridge, and before starting QFEX, worked as a quant for nearly 3 years at Tower Research Capital, one of the top high-frequency trading firms in the world. Annanay, welcome to Him's House.
Thank you for having me, Jonathan. Great to be here. Wish it was on a better week, but good nevertheless. I'm sure we're going to have a very interesting conversation.
Yeah, let's do it. I want to start with your background, which is high-frequency trading. I think it's fair to say that this is one of the most secretive industries on the planet. What can you tell us?
Yeah, I'll tell you as much as I can without getting sued by my former employers. But
Yeah.
basically, aim of high frequency trading, it kind of started from these pits in Chicago where trading used to happen. And basically, people figured out that people want to come and buy, and then other people want to kind of sell, and those people don't necessarily meet at the right point in time. So, how can we create a service that monetizes that and helps these people find each other? And what people would do basically is they would buy from any willing seller and sell to any willing buyer and try and set their prices so that they would stay roughly flat in terms of their own position, but they would take on a little bit of risk in order to facilitate this kind of transaction. So a lot of you might be thinking, oh, how is it different from a used car dealership? It's not. It's basically exactly the same as a used car dealership. It's just like with financial products instead, and they set the prices and they basically get rewarded for the risk they take on while they hold those positions, and the underlying might move. So if you want to make markets in HIMS, you have a tough job because there's a lot of sellers, there's not many buyers.
Yeah.
And high frequency trading is just like automating what the pit traders used to do in Chicago and all these other legendary places that have had big stock exchanges, New York, NYSE, NASDAQ. Automating that using algorithms and computer models to figure out these prices instead, and hiring people like me who have degrees in math, physics, computer science, and no other way to monetize them easily to do this for them. That's basically high frequency trading in a nutshell.
Yeah, so you compared it to car dealerships, but I was going to ask, what are the people like? Because I think car dealerships attract a different type of person. You studied maths at Cambridge, right? Who else are the people who are taking these jobs? What did they used to study?
Yeah, they look pretty similar to me. So kind of STEM background, math, CS, physics, engineering, those kinds of subjects.
Geniuses.
No. Good at problems that used to be useless until a few years ago when people worked out you can use them to predict markets. So now they're useful. I don't think anybody, like maybe things have changed now, but certainly when I applied to university, like I just enjoyed like the maths, right? And like I wanted to study it and like maybe do a PhD and become a professor, all these idealistic things. And then, you see the pay packages these firms are offering, and they're even higher now. It's hard to say no. And yeah, I mean, like I've given like a very broad view of what high frequency trading functions to do in the world, but ultimately on a day to day, you basically have some strategies that make money, and then you think, okay, how do I help them make more money? And it's usually by finding trades that you think they could have done better, and basically creating either improvements in the models or in the way that you send orders to the exchange and kind of trade in the portfolio, and just improving the code and testing it and making it function better and deploying it and things like that. So it looks like a tech job, maybe like a data science job, but much more high pressure, I guess, dealing with like live money that is trading millions, trading billions a day and usually making millions. So it kind of a weird data science tech world meets Wall Street. You get people who are still very competitive, very type A, like the Wall Street people, but still kind of nerds at heart, and didn't necessarily come into college thinking they were going to go into Wall Street, and then kind of it found them rather than the other way around.
Sure. You work for Tower. What are some of the other top firms? Just like rattle off a few so that we know the lay of the land.
Yeah, so I guess Jane Street has been in the news a lot recently, historically very secretive. Hudson River Trading are pretty well known. Other top firms include, maybe slightly less well known, but Jump Trading, Headlands Technologies, XTX Markets, Optiva, IMC Trading, all these kind of try and do Susquehanna, all these kind of try and do the same thing in slightly different ways, targeting different asset classes, slightly different styles of trading, but they would all consider themselves competitors. I think, like, if you went from one firm to the other, they wouldn't be too happy about it.
This type of trading, this type of investing, I don't know if we can even call it I don't know what you would call it, if you even call it investing. It's so different from what I was reading about 10, 15 years ago with the intelligent investor, right? Very different from Benjamin Graham, very different from Buffett, Munger, Peter Lynch, Howard Marks, all of the so-called greats, right? I'm curious to hear, what is your mental model towards, say, value investors or fundamental long-term oriented investors? How do you think about that bubble of the financial industry?
Well, I think they're much smarter than me, right? I don't know where.
Do you think that?
I think so. Yeah, I think they know. I have no idea where stocks are going to go, right? Like I didn't know HIMS was going to be down like 30% this week. Whereas I feel like a lot of people in the industry maybe did. So
yeah,
our job, I think I alluded to this at the very beginning. Our job basically is to help people who want to buy or sell any stock, commodity, FX instrument, whatever, find each other and transact with each other. Because you forget that you can go into Robinhood, you can go buy your shares, but somebody has to be on the other side of those trades, right? Every buyer, there must be a seller. And our job is to help them find each other, and we don't really know where the direction of these prices is going. We have very short-term models that tell us that, hey, if a stock is trading at like $100 and bid and it's $100 and one offer, basically you can buy it for 100.01 and you can sell it for 100. We have models that can tell us like, okay, maybe in the next second or the next 5 seconds, the next 30 seconds, the stock is going to go down, but where it's going to perform in a day, I have no idea, right? So very short-term stuff, very different way of thinking, and like that's the beauty of the markets, is that you can play the game at any level of magnification of the microscope, and it looks like a different game every time, right? It's like you can play this very low latency game, and what you're basically offering is a service to the people further up the stack, people who are swing traders, day traders, scalpers. These guys, they may know something that you don't know. They're basically exacerbating momentum or causing mean reversion more for the fundamental people who view that as noise, and they're like, okay, there's some move that's been caused by these like short-term traders. We have a long-term thesis on the stock. We know the business. We understand the founders, the CEO. We know what the capital structure is like, right. And these short-term moves, they're gonna smooth out like it's wrong. Like we're gonna buy and hold, or we're gonna short the stock for a long period of time. Both on the retail side and the institutional side, right? So it's we are in humble service of the people who trade at longer term time horizons and who have fundamental theses. And our model is such that we basically have to write code that can translate to any stock and trade it equally well. And that makes it very hard to really narrow down and focus on one thing. We just don't have the manpower to do it. So it's a whole different game, basically. I actually don't know many people. I look at them with awe. I think, what are these guys up to all day? I have less understanding of their methods, but I do know where all the volume and flow comes from. Because in high frequency trading, you often do 40-50% of the transacted volume of the stock. If 10,000 shares of him is trading a day, I could be doing 5,000 of those shares. I could be on the other side. So I know where all the volume is coming from. I know who all the shorts are, but I don't know why they're short. That I can't tell you.
All right, let's get into QFEX. You left your presumably very high-paying job as a quant to start this exchange, right? What is it, and why did you leave? Why did you leave Tower to do this thing?
Yeah, so what we're making is basically a new kind of financial exchange, which features basically new architecture, new infrastructure, new product lines that allow people and institutions to basically trade in a more efficient way. And what do I mean by more efficient? I mean 24/7. I mean
Like
they can short
Saturday morning,
yes,
Sunday afternoon.
nonstop. Whenever you can get away from the wife, kids, girlfriend, whatever, you can trade. You can trade with like way more capital efficiency. So you can go, on QFEX, start out with, you can go long or short 10x on any of the stocks that we list. That's offered
10x.
to like all users, 10x.
Yeah.
And
I've heard you say 100x.
so we do. We're going to increase the 10x to 20x once we're more confident in the exchange for stocks.
Okay.
For FX, we start with 50x if you want to trade Eurodollar or something like that, and that will rise up to 100x at some point. But that's already way better than you can get on Robinhood.
Right. Oh, absolutely. Right now, you could go onto QFEX and trade HIMS 10x.
Yeah.
Oh, wow. Okay.
Yeah, absolutely. So, and you can short as well, which is it's kind of hard to do. If you want to short, I'm not encouraging it, but it seems like a good bet right now to go short him. So you can do that as well without resorting to options and other structures which are far more complex. And the way we built it is we've taken inspiration from a lot of crypto exchanges and the way they've managed to offer a superior, lower cost, more efficient, and better user experience, trading experience for their customers. And we've kind of adapted a lot of those technologies to work in the traditional financial world. So a lot of tweaks that had to happen for traditional finance, and we've taken them across. We've adapted them. We've made them better in many cases. In other cases, we just kind of had to rework the thing and make it work there. And we don't actually offer any crypto, so we're 100% focused on equities, on commodities, metals, FX. And that's basically QFEX. Why did I leave my job to build this? It was actually in my job that I had the idea for QFEX. So in my last job, used to trade crypto markets. We were doing very, very high market share. And basically there was some restructuring in the team, and I was moved to a different manager who was trading commodity futures in both the US and China. And I thought, okay, it's super interesting. Commodity futures, bit of a different market. And then the more I looked into it, if you work in high frequency trading, your aim is to service the exchange, right? So you basically work as hard as possible to give the exchange as much liquidity and as little transaction cost as possible. So you understand the exchange really well. And the traditional exchanges work very differently to crypto exchanges, right? Like crypto exchange is it's like a Robinhood and the exchange in one, right? So if you go trade on Robinhood is the app, but it connects you to an exchange where the actual trading happens. Crypto exchanges, the whole thing is one stack. And that makes it really efficient. That's what allows you to be able to deposit money and it lands instantly. You can trade very, very few clicks from first opening an account. You can trade 24/7 because the money doesn't have to move around between different entities. So it's really like technological improvements that have enabled this to happen.
And that's what QFEX is, but for traditional financial markets.
Exactly. So I basically noticed this big gap in my last job, and my thesis was always that I thought there's retail interest, obviously also institutional interest. I thought a lot of hedge funds that go and trade on these traditional markets do a lot of volume and a lot of size, big banks. They don't want to trade on a market where they have to put 100% of their capital down to do the trade. Maybe they just want to put 50% or 10% of their capital down. They want to trade with leverage, and we can make that happen. And a lot of the things we offer, maybe listeners, viewers, AI agents who are listening to this podcast have seen The Big Short. Great movie where there's a scene where they go into an investment bank to try and get a deal to trade some of these securities. So at the moment, you can trade the things that we offer on exchange, but if you have a direct relationship with a big investment bank, but you need $1 billion to get one of these licenses in place. It's called an ISDA agreement. And, we really thought, like, let's democratize this, right? Like, we want that access to come to everyone. It shouldn't just be the billionaires who have friends at big investment banks and lawyers that can look over the agreements that do this. And that's where the idea came from.
Yeah.
It's pretty bullish on the idea. I managed to convince one of my best friends to work on it with me. And here we are.
Enjoy my weekends generally. If it's a rough day in the markets on Friday, I'll be sometimes, a little less happy over the weekends. But generally, I like not seeing fluctuating prices at like 11 p.m., right? Or Saturday morning or Sunday afternoon. I guess Sunday afternoon, I'm sort of anticipating the futures opening that evening. But I generally like having 2 days off.
Mm-hmm.
Can you make the case for why we need 24/7 trading?
Yeah, I mean, it's more like, the world time still progresses over the weekend, right?
Yeah.
So
Things happen.
Things happen, right? Like Trump, Greenland, Iceland, whatever. Right. Like, things happen, right?
Bitcoin could crash 15%, anything.
Yeah, exactly, right? And when that happens at the moment, right? Trump says something, Elon says something, whatever. When that happens, what happens currently is the only risk asset in the world which is open right now on the weekend, which is Bitcoin and other cryptos, moves. And that's when you start thinking like, oh, this thing has happened, which is probably bad for stocks. And now Bitcoin's fallen 10%. So my stocks are probably going to open down. So it's not like, if Friday night to Sunday evening or Monday morning, if it's a stock, the price was guaranteed to open the exact same place, then your weekend would be in peace. At the moment, you're in this double whammy of, you don't know what's happening, right? Like, if nothing happens on the weekend, the prices won't fluctuate anyway. If something happens, you now don't know where your position is. And that's what we're trying to avoid. And we feel the most effective and the most elegant way to handle this problem is to have the markets open 24/7. It has a lot of good benefits, particularly in terms of leverage, right? So if you go on Robinhood, right, and you want to trade with leverage, Robinhood can't give you a lot of leverage right now. It's due to a lot of things, but one of the things is, if you want to buy, let's say, Tesla or Palantir or Hims or Google, whatever, with leverage on a Friday, and Robinhood says, okay, you have 10x leverage, a lot can happen between Friday night and Monday morning that could cause the Google price, the Palantir price, the Hims price, the Tesla price, whatever, to fall by more than 10%. And if you've gone 10x leverage and the fall price more than 10%, you're now underwater. And when the market opens on Monday, maybe you're down 15%, but actually your account is down 150%, right? And now Robinhood have taken the other side of that loss because your account is actually a negative.
Right.
So that's why they don't want to give you a lot of leverage. If the market was open over the weekend, by the time the exchange moved down to 10%, your position would have been liquidated and Robinhood wouldn't have taken a loss. So they'd be happier to give that to you because it would have to move down and there wouldn't be a gap, right? There wouldn't be a 2-day gap.
And that's why Vlad is pushing for this as well.
Absolutely. I think it would be a huge unlock for them from a risk management perspective. There's much more complications doing it with the actual stocks. We do it through derivatives contracts, which we feel are a cleaner and more elegant way of handling this. Yeah. They track the price of the underlier. Vlad's trying to do with stocks a more daunting problem. Obviously, they're a bigger company, so they can tackle the problem. But we are offering it right now with futures contracts, which track the underlier and have inbuilt native leverage.
Okay. Wow. This was something that we chatted about over coffee, and I want to share it with a broader audience. You said that high frequency trading makes it hard for the retail investor. I am a retail investor, right? And you said that the vast majority of people that you know just buy the Qs, the QQQ, the index that tracks the NASDAQ. Why is it that you guys just buy the Qs? And is it fair to say that high frequency trading rigs the market for the retail investor, or would that be going too far?
The market wouldn't exist without high frequency trading, which is a very interesting thing. Because as I said, the high frequency trading exists to serve a function, which is to have liquidity in the markets, right? So it's a double-edged sword. If you want to go out and you want to look up the price of any stock out there on Google, the price exists because high frequency traders have put in orders into the exchange where they're willing to transact at those prices, right? Otherwise, there wouldn't be a price.
What about 30 years ago?
30 years ago, they did it in the pits. So there was no internet back then. You would have to call your broker, and he would check in with this guy in the pits, and he would tell you the live price. But high frequency trading is just an automation of what was happening in the pits.
Is it bad for the retail investor?
So the markets can't exist without high frequency traders. What retail investors should be very careful not to do is to try and play the high frequency traders at their own game, because they're more capitalized and they have better infrastructure than them.
Got it.
So you asked me, what do you think about the guys who, the value bet investors of the world, right? Like, the people who study the fundamentals. To be honest, I think they're playing a very different game, and I don't really understand them. And this is why we see, there's a lot of people out there with a lot of success in trading and long-term investing, value investing, long-only hedge funds doing well, financial institutions which don't really have high-frequency traders, quantitative models also outperforming. It's because they're not trying to compete on the same game, right? So they just use the high-frequency traders to transact into the market. The high-frequency traders offer them competitive pricing, and it's competitive because they're competing with each other to offer the best possible pricing, and they use them to execute. And as long as the high-frequency traders can find somebody else with an opposite thesis, also with a long-term view, to execute against and exit their position before the market moves against them, the long-term investor can also win. So if you're kind of in, if you're a retail investor and you're trying to make, you don't really have any background in programming or finance or markets, and you think, hey, I'm going to start making automated trading bots by myself with no training and no instruction through Robinhood, I think that's not a great idea. Probably you might be able to do it, but the odds are stacked against you, and it might be better to kind of go out and seek instruction on how to go about doing this properly. And if you want to do anything that's really competitive, then high frequency traders have put a lot of time and investment into. It's very unlikely you'll actually be able to win at their own game. If you want to do something that they don't consider at all, for example, long-term investing, long-term bets, it's very reasonable. And I think the markets basically will not run against you when you do that. There are, I think something else we also discovered is there are other types of investors in the market, not like high frequency traders, who maybe, trade in a way that doesn't make sense to the average retail. So we discussed, why is a short interest in HIMS so high, for example? And I came up with some hypotheses, and I was like, it's not necessarily always related to the actual price of HIMS, because people could be trading HIMS in order to offset positions that they've got in other products. And it's not a reflection on HIMS price, whether it's going to go up or down. It's just a reflection on the way these strategies work. Those aren't high frequency strategies, but yeah, I think they're also not very hard to understand. So if you are a retail investor and you want to invest these things, it's important to be aware of all the different ways that people go out and trade stocks.
All right, let's move to HIMS. You mentioned that you added HIMS to QFEX. When did you do that, by the way?
We're actually doing it on Monday, so it's
coming
happening.
Oh, wow.
It's coming up.
So,
yes.
This episode will drop on Monday. So, the day that this comes out, HIMS will be on QFEX if you want to go and trade HIMS up or down on QFEX. Why did you make the decision to add it? Like, what is it about HIMS, the stock, probably not the company, but HIMS, the stock, that made it good for QFEX?
Well, it's you, Jonathan. You told me to add it. No, I'm joking. There's lots of reasons.
Did I say that?
Yeah. Well, your enthusiasm for the stock is infectious. So we wanted to add it. No, I think if we look at what value we're really creating for the space, right? I think there's a couple of things. One is like the ability to short stocks without going into this, these complicated put options where you have to select a strike, you have to select an expiry, you don't really know, like liquidity is fragmented across a bunch of different order books. You kind of feel like you have to be a genius to know even how to go short the stock and how to transact in that market. Yeah. We're giving the people to be able to short in a very, very intuitive way, very, very simple. If you open a short at whatever, take any stock, say it trades at $1,000, and you open a short for one share and it goes down to $900, you're going to make $100. Okay, so that's pretty simple. It's much simpler than options. If you go buy a put option on a stock that trades at $1,000, you have to tell me the strike and the time to expiry and the amount of time you hold it, how much the underlying moved, and then I can maybe give a guess for you, like what your option price ends up being and how much money you end up making. I don't think anyone really knows without sitting down in front of a Black-Scholes calculator. And the other thing that's very interesting for us is the volatility, and we want to make it easy for people to transact in a very low cost way, and potentially trade some of the volatility. I think that's interesting. I think there are people out there who have a genuine kind of long-term view on the stock and kind of its underlying business fundamentals, and maybe they feel that the market is not expressing that properly, and they want to put their money where their mouth is, but at the same time they don't want to risk like all their capital on one exchange, right? So we offer the ability to do that with leverage, and I think HIMS is a great example for a stock that a lot of people have actually been asking us for on both sides of the equation, both the bulls and the bears. And that's when you have an exciting market, is that you have a bunch of people who both want to take other sides of trades. And we as an exchange have no view on the stock, right? Like, we don't take the other side of the bet. We just want to help you guys find each other at the best possible terms.
You just want action.
Action, that's it.
So one of the reasons that I thought it'd be so good to have you on is that HIMS has the highest short interest on the S&P MidCap, and like quickly becoming one of the most shorted stocks on the entire stock market in the entire United States. I don't know exactly where it ranks, but it's certainly top 10. The short interest is now 76 million, which is close to like 45% of the float. Depends how you calculate the float, but It's like a massively shorted stock. You said something very interesting, which is that this dynamic could be entirely unrelated, like potentially could be entirely unrelated to the fundamentals of the business. Now, we had, like, generally when people come on and they have a view of HIMS, I like to ask, why do you think it's one of the most shorted stocks in the entire stock market? Because the business, the underlying business, is pretty good, right? Profitable like 10 or 11 of the last 12 quarters, something like that. We don't have to go through all of that now, but there's a lot to like potentially about the business. So I like to ask people, why do you think it's so shorted? Martin Shkreli said, situation where you have growth rates over 100% that are collapsing, right? And so anytime you get the growth rates that high, but they're going to come down to likely 30, 40%. And I think where we are headed is well below that, probably 15, 20%. The shorts like to pile on. But I replied, like, does that really mean that it should be the most shorted stock on the entire stock market? I don't know. I guess, like, maybe, but seems a little extreme. We had Adam May on the show. He's one of the biggest HIMS bears on the internet. And I think his explanation is just that, like, HIMS is running this GLP-1 scam where they're ripping off Novo Nordisk's intellectual property, and the trick is going to end at some point, and like very well this may be happening soon with the lawsuit, or at least that's the reason the stock is off 30% in the last week, right? So those are both fundamental stories about why the stock is so shorted, but according to you, it may have nothing to do with any of that. Is that right?
Yeah, absolutely. I mean, like, so I would say, as I said before, my superpower is I don't know that much about, I know a little bit about HIMS, but I'm never going to pretend to be the expert there. I have no edge there. Certainly the people you've had before me have more fundamental knowledge of the business. But the magic that high frequency traders have is we understand where all the flow is coming from, and we understand indeed where the short interest may lie, because we see a lot of the flow, and we don't necessarily have to link it back to fundamentals. And the explanation I gave is, typically retail don't actually short in very high numbers.
Right.
So whenever you have like a big short interest on a stock, there are exceptions, but generally it tends to be institutional short interest. And a lot of institutions that go out and trade stocks in big sizes and hold these positions for a long time are so-called long short equity funds, right? So you basically have generally there's like two kinds of hedge funds that trade stocks. There's kind of the long only ones that just bet on prices going up, and there's long short ones, and they're a little bit more risk diversified, because the whole idea is generally markets move, the whole US stock market moves up and the whole US stock market moves down overall. So if you just buy stocks in your hedge fund, are you really creating alpha? Do you really have edge? Or are you really just following the direction of the US stock market, which is generally up only? So to counteract that, basically people basically have funds where they have some requirement where generally let's say like very loosely every dollar of stock that you buy you have to sell a dollar of a different stock, and teams will basically work together and they'll trade these in sectors. So they're betting on relative out and underperformance of different kinds of companies. And because they trade in such big sizes, because they're supposed to be kind of risk neutral, because for every dollar they're long, they're short a dollar and they have less size, they can really exacerbate moves in a sector. In the sense that if an equity analyst on one of these, Citadel has like a really famous equity long short team. So is Balyasny Capital Management. They're a Balyasny Asset Management. Sorry,
Citadel, I should add, Citadel has a position in IMS, and if you look at the reporting, there's either a call or put position as well, but they may also own shares. But yeah, Citadel is definitely involved here.
Yeah, absolutely. So these funds, what happens is there's teams and they'll say, well, we really like this stock, and now we want to be long $1 billion of this stock, right? And now because we're a long short hedge fund, risk has told us, again, approximately, we need to be short $1 billion of another stock in the same industry. And once they pick their winners, there can just be a case of there's just only one other stock left, which is going to offset the risk, right? They basically pick the stocks they want to buy, and then the risk model tells them, by the way, due to your mandate, you now have to sell all these other stocks. And they'll be like, okay, maybe I don't even know about this stock, right? Like, okay, done, right? Like, I don't care. I'll do it to make the risk people happy, and I'm indifferent on whether it's long or short. That's a very, very common thing that happens in the industry, and it explains a large part of short interest for like multiple assets out there. Like I said, that if you just look at fundamentals kind of on its own and look at HIMS as a company on its own without reading too much into other spaces, the amount of short interest, I'm going to comment on the price action, but the amount of short interest maybe isn't justified. And that's when you have to start looking at these alternative viewpoints of maybe there's a hedge fund manager out there who just likes another stock which is related to HIMS, and then his risk manager said, okay, now in order to offset this position you need to short a big load of HIMS. And markets, honestly, a lot of explanation often just comes from the top few players, especially on the short side. As I said, it's kind of hard for retail to short. You have to source somebody to borrow the stock off in order to sell it. And if it's happening in such big size, you can kind of bet your hat off that there's a hedge fund manager somewhere out there who's doing it. And the problem is a lot of these hedge funds actually run the exact same strategy. So what will happen is, the manager at Citadel who's in charge of this position, he'll get poached to a competitor, Millennium, let's say, another big famous hedge fund. He'll run the same strategy over there, and then they'll have a third colleague who she'll basically meet with them for coffee, and then to be like, oh, these guys are already putting this trade on, right? Like, here's HIMS competitor, they're gonna long it. Here's the HIMS, and they're gonna short it. That means the price of these stocks is gonna move in this direction because there's a lot of short interest, or drive the price down. So I may as well pile into this trade, right? Because if I don't, I'm not going to make this free money that these guys are telling me. These guys are going to move the market for me already. I may as well get in on this as well. So there's a lot of groupthink, and
is that legal? Is that collusion?
It's I mean, as long as it's not on material, non-public information, it's fine, right? I can go up to you and I can tell you, hey, I'm long $1 billion of HIMS. I mean, I don't have $1 billion, so maybe I'm not, but if I go up to you and I tell you I'm super long a stock, and you think, oh wow, this guy, maybe he has a lot of money, maybe he'll actually drive the stock price up, you're allowed to buy on that information. That's fine.
I do not. It just seems when that amount of money is involved that it could be classified as manipulation, but I don't know the laws. I mean, it's totally fair game.
As long as it's not done manipulatively. So I think the issues arise where they get really into brass tacks and they say, okay, this point in time, my guy is going to click the buy button, and then I want you to click the buy button at the exact same time so we can rip the stock up at the same time. That would definitely be manipulation. But hedge fund managers like to go around. They're like, Bill Ackman is someone who does this very well. He's an activist investor. He would take a huge long or short position on something. Herbalife, for example, he went all out on Herbalife, and he was like, I think it's a scam. I have a huge short position. Here's my short position. And yes, you could agree with him. You could disagree with him, but you could also just say, well, he has a lot of money and he has a huge short position. Maybe he's just going to drive the price down. I can pile into that as a retail investor. There's nothing wrong with that, really.
What is the main way to tell if shorts are fundamental shorts or technical shorts?
Yeah, I mean, like if you look at
ask, is there a good way to tell, or is that a bad question?
No, there are good ways to tell. So you can look at like public disclosures, you said. So U.S. securities have disclosure requirements where certain corporations or companies or individuals are required to disclose large long or short positions, either in options or in stock, in a particular instrument. You can bet, if Citadel LLC have a huge short position, Citadel don't go around shorting stocks willy-nilly. Their only strategies are long short. So the only way Citadel trade equities is if they long $1 of a stock somewhere, they have to short $1 somewhere else. Now, it could be that the portfolio managers hated HIMS, so he shorted HIMS, but it could be he just liked a different stock, and then the risk manager said, hey, you have to short something related to it in order to make down the risk.
Got it.
So you can look at the types of people. There are certain people. If Bill Ackman shorted HIMS, that would be a bit worrying, I think. But there are a lot of people who trade only on these like very technical reasons. I mentioned otherwise as well, kind of options hedging. We talked about that briefly as well. That HIMS put and call options, the volatility seems to be pretty overpriced, and
Extremely high beta, right?
yeah, exactly. So people are selling put options perhaps, and then they're kind of getting implicitly long the underlying stock, and then they're selling the stock to hedge. That could be a reason that people go short as well. There's a very famous options market making firm. So you talked about high frequency trading. I said they basically there are these firms that exist that basically provide prices for all these stocks.
Yeah.
Also happens on the option side, right? And the biggest firm that does that in the US is one called Susquehanna or SIG. They often end up in public disclosures because they've basically had to trade so many options as part of their normal business. In order to hedge the risk on the options, they've had to trade so much of the underlying stock that they actually end up having to disclose it because there's such a big percent of the short interest. So there's such a big percent of the holders of the stock. So that's not uncommon at all. And that's like very technical reasons. Like SIG, I can tell you, they think the same as me. They don't have any fundamental position on the stock.
Yeah.
They are ultimately facilitating trades for people who do, but it's already like one level removed. So, you disclosures do work, but you really have to understand the game at play behind them to understand what ends up in disclosures and how you can interpret that. It's not always interpretable one-to-one. It's usually not, as a matter of fact, and you usually have to look at like who's behind this, what are they doing, what's the reason they're doing this for, and then kind of figure out from there.
Okay. What would reverse the trade or get the shorts to back off? Is it just fundamental stuff? Is it positive news for the company? Or are there some technical indicators that could flash that could lead to the shorts changing where they put their money?
Yeah, I mean, look, the only, and on a very long term horizon, the only thing that really matters are fundamentals. I think, all the things I mentioned, I said like, there's a manager at Citadel, let's say, who's going short HIMS just as like on the back of some risk manager telling them they have to go short HIMS. Now, if HIMS was doing really, really well, then maybe they would have just gone long HIMS in the first place and shorted something else, right? Like, so if a company is doing super well, it should have very high, very low short interest, and the stock should be doing well. Yep. If a company is doing very badly, then it should go the other way. What I'm saying is those companies kind of in the middle, there are explanations sometimes as to why the price is not necessarily in line with what we would expect, and why it's sometimes very up, sometimes very down compared to where you would expect. So certainly improved performance by the company would do wonders. I think especially a lot of tech stocks in the US right now are driven more by story than fundamentals. You look at some of the valuations these private companies are attracting. People want to invest in these kind of sexy, high growth, high potential stocks. Certainly of him kind of said, okay, yes, we have this cash cow business, it's profitable, it's making a lot of money, but like, let's look further afield. Let's try and be the SpaceX of health tech. Let's say, look at a company like Harvey, right? Like Harvey's not exactly in the same space, but they're working with chemicals that basically, kind of health related, and they're going to make probably, they've got the Harvey bar right now, but they can use that formula, the EPO formula, to make a bunch of other snacks, which previously were very unhealthy, and now we can have like maybe 4 ice cream packets a day. Certainly if they came out with a 0-calorie ice cream, I'd probably have 4 a day, right? So I think that stuff really helps a lot, like the growth equity story, and it kind of helps justify people why their market cap or their valuation might be different to the actual fundamentals of the business if they have more of a growth story there. And I think in the short term, to burn the shorts, being short is a tough game, right? Because it's expensive to fund a short trade. It's very easy to be long something. If there is a short-term rally, like a very quick rally, a lot of those shorts would have to close out their positions by buying back from the market, and that would fuel the rally even more. So it's very interesting. You always talk about short squeeze, never a long squeeze. Shorts can be squeezed out of positions very easily, and if there's a quick rally anytime in the next few weeks, months, whatever, as long as it's sharp and snappy, that would force a lot of people out of those positions. That's what we're all hoping for, right?
Okay, so this could be a quick answer, but I'm really curious. HIMS is down. I think it's 17 of the last 18 weeks now, 11 straight weeks, and 10 straight days. This is like a world historically bad run, at least.
Yeah.
At least it seems to me. Do you have any sense for like how statistically unlikely that sort of price action is?
Yeah, I mean, 10 straight days, like if you have a very naive answer, let's say it's a coin flip whether a stock goes up or down on any given days. 10 straight days going down, that's like a 0.1% chance roughly. So 1 over 2 to the power 10, 1 over 10, 1024. So around, 0.1%, 10 basis points. Very unlikely, basically. It's like 10 coins coming up heads in a row. In reality, there's like a degree of autocorrelation to that. So if a stock goes down one day, it's slightly more likely to go down on the next day, but not by much.
Okay.
Yeah, that's like a first level like mathematician's glance at the whole problem. But yeah, it's not great, right? And at some point it has to bottom out, right? Like because at some point, kind of sensibilities have to prevail, and people be like, this thing does make money at the end of the day, and eventually it will just become very cheap from a value perspective, and people start to pile back into it.
I think so too. Yeah.
Yeah.
Want to ask you, this is one more question about what might account for the short situation. There's one account, I mentioned him before, Adam May, one of HIM's biggest bears. I'll just read a tweet that he wrote a few weeks or months ago. He said, the hedge funds who bought the HIM's convertible notes. And so I'll just give you some background. HIM's raised $1 billion in convertible notes last year. The hedge funds that bought these notes, he says, in May, largely did it because they wanted to short the stock, not because they were getting hosed by retail and duped by buying notes above market value. They aren't idiots, and many of them were likely not HIM's bulls. HIM's basically monetized their stock's tendency to short squeeze, and in so doing prevented any major squeeze from ever happening again. Thoughts on all of that?
So HIM's monetized their tendency to short squeeze, or the investors did there? Sorry, just read back the last part of that statement.
He says, not because they were getting hosed by retail and duped by buying notes above market value. He's referring to the hedge funds there.
The hedge funds, yeah, exactly.
They aren't idiots. I think he means the hedge funds.
Hedge funds.
And many of them were likely not HIM's bulls. HIM's basically monetized their stock's tendency to short squeeze, and in so doing prevented any major squeeze from happening again.
Yeah, so convertible notes basically are they're like loans, but they basically convert into equity and under certain circumstances, right? And I think what's being said here is that basically HIM's issued like a debt raise, for example. So they didn't want to sell equity, so they raised debt, and a bunch of hedge funds went out and bought this. And effectively, I think what he's saying is, HIM's wanted to, let's say, they wanted to issue debt in order to kind of protect themselves, and they sold it at valuations that were very attractive to hedge funds, right?
Yes.
And the hedge funds were kind of forced to buy it because they were like, this is a good deal, but we are not actually bulls on the stock itself. We're just buying this debt, which may convert into equity, because we just see a good deal and we have to take a good deal when we see one, not because we think there's like a growth or a value story. And doing so, basically, HIM's aligned a bunch of these hedge funds in like very loose terms with their price, and basically prevented a squeeze on the price, basically.
And I guess why would that prevent a squeeze?
Yeah, so basically these hedge funds now own a bunch of these convertible notes, right? So if the price goes down too much, then they're now holding a load of losing equity, which is not great. So the hedge funds are now incentivized to make sure the price stays up, and that's kind of the the gist of it. So it's kind of like paying, for the insurance of your price going down in some sense. It's not necessarily the best thing in the world for him because ultimately they are selling these notes at a slightly off-market price. It's like saying in very loose terms, it's like, imagine Hims owns like a mansion, right? That's their whole business model. And they want to basically buy insurance on the mansion burning down. Now, buying insurance like might be a good thing, but what they've done is they've overpaid for the insurance a lot. So, if the house burns down, they're going to get a payout from it. But maybe you'd rather they just like didn't buy the insurance. It was so expensive anyway, right? Like maybe the house was worth like $100 million, but they paid $50 million for a year of insurance, which you're like, okay, man, like it's kind of okay, but like you have spent a lot of insurance. Like maybe you should just spend this on the business.
Yeah.
So yeah, it's a bit of a complex thing. This is, complex derivative products, hard to kind of unpackage. I would say you need to understand what's going on under the hood. Like what was the reason for the debt raise? What were they planning to use the money for? Or understanding all those things is kind of pretty key to unpacking a statement like that. Yeah.
I want to move beyond Hims to, you may have mentioned this earlier or something like it earlier, but I've noticed this in multiple retail favorites in the last 3 or 4 months. Jane Street takes a 5% plus position in a popular retail name. It's happened with Cypher. It's happened with Open Door. It's happened with, I think, a couple others that I'm now forgetting. And you see it all over Twitter when it happens. Jane Street takes massive stake in this company or that company, and all of the retail army gets very excited, and then someone chimes in, oh boy, actually you don't want Jane Street involved, or actually this doesn't really mean much about like this doesn't mean they're bullish. If anything, it might mean that like they're lending the shares to shorts or something. What is this? What does it mean when Jane Street gets involved at an elevated level?
Yeah, sure. So very, very good question. So your Jane Street is basically it's kind of like the firm I used to work at, Towers. That's how they started.
Yeah.
They actually also came from these pit trading backgrounds. Some of them were nerds. They learned how to program computers. They make the computers do pit trading for them. That's how all HFT firms start. They've moved more into doing business, which is kind of more like what banks used to do. So more kind of like big balance sheet, heavy trading business rather than just trying to be flat all the time in market making. But ultimately, most of their business is still around the scope of let's do some kind of trading and make markets for someone who wants to transact in the markets, and we go and hedge that risk somewhere else. So I mentioned before, a lot of the times you see options traders. So Jane Street are now very active in equity options. What happens is a bunch of retail want to go and buy options to think a stock's going to go up, right? So they go buy call options, right, in the market. Jane Street is then the seller of those call options because Jane Street's job is to provide liquidity and provide a counterparty for everyone retail wants to trade against. So Jane Street are now short these call options. That means Jane Street, in order to hedge, have to buy the stock, right? Because if the price of the stock moves up and they're short all these call options, they're going to lose money. So Jane Street go out into the market and they go buy the stocks. And if retail really, really, really heavily want to buy call options, Jane Street might have to buy so much stock to hedge that they actually show up in disclosures and they're now super, super long. It doesn't mean Jane Street have a position. It doesn't mean Jane Street are going to benefit from the stock moving up or moving down. It just means that they've facilitated a lot of trading from other people who are long. So it can be a good thing. I mean, if they go, it usually means that some other long-term holder has traded against Jane Street, whether that's a lot of retail trading on an exchange or whether it's like a big hedge fund or a big pension fund. They've traded against Jane Street. Jane Street's taken the other side of the trade. So somebody else is now very long the stock. Usually would be a good sign. Whenever you see someone...
You do think it could be a positive sign?
I think so, yeah, definitely. Okay. It shows an indication that there's someone big or a collection of people who are very big who've all transacted in the stock, and Jane Street has basically made the market for them. And in order to make the market for them, it's usually through options, right? If somebody's like very bullish a stock in the short term, they usually buy call options. And they bought all these calls, and Jane Street had to buy all the shares in order to hedge themselves because Jane Street is not in the business of speculating. Jane Street is the business providing liquidity, hedging risk, and making a risk-free profit. So you have to be a little bit careful and understand the business model of a lot of these HFT firms like Jane Street. their business model is not really, they're not trying to make retail lose money. It's just if you try and compete with Jane Street at their own game, you'll probably lose money. But if you're trying to, let's say buy a stock, if you want to buy like a million shares of Hims, right? You have to go to Jane Street and say, hey, please can you source me a million shares of Hims? Because there's no one else. You can't go and buy it on the exchange. You can't buy on Robinhood, for example. And if there's a big hedge fund manager who wants to do that, they're gonna have to go to Jane Street and say, hey, you can try and buy a million
on
shares.
Robinhood? I'll pull it up and type in a million.
A million? Okay, let's see what they do.
I'm not at the $16 million mark in my account, but
In your account.
let's see what they.
Let's see.
Let's see, 1 million. Review order. Okay, so the maximum order value has been reached. Please update your order to less than or equal to 5 million. Okay.
5 million? Okay,
Yeah.
exactly. There you go. So $5 million, I guess, notional.
$5 million. Exactly.
Dollars, yeah, exactly. So, I mean, $5 million isn't much for like a big hedge fund manager, right? You might have like $1 billion to play with. There's no problem. You can't do it on Robinhood, right? Like you got to go and find Jane Street, and then the way it's going to show up in disclosures, right? Jane Street going to hedge it in a bunch of different places. Is Jane Street are now, they're now long $1 billion of Hims. So that's not necessarily bearish, right? That could be that some other hedge fund manager out there is like wants to buy this stuff. They've just used Jane Street to do the execution for them, and therefore they're one step removed and one step hidden, basically, from the underlying trade.
Any chance that the same sort of thing is true of JP Morgan? JP Morgan revealed, I think, like an 8% stake in Hims several months ago. Could it be similar dynamics there?
Yeah, it's very likely similar dynamics. So banks have an additional restriction called the Volcker Rule, which is created by an act called the Dodd-Frank Act passed post the 2007 financial crisis, where basically they're not actually allowed to take proprietary positions. So a director at JP Morgan can't say, hey, I want to go long 10% of the free float of Hims today. And take that risk on the books without any kind of customer justification. It's just not allowed. So if someone like JP Morgan is long 8% Hims, it means one of their customers is long 8% Hims, and they've executed through JP Morgan as their broker.
Got it.
So doesn't have to be positive, doesn't have to be negative. Probably is positive, to be honest, in that case. It shows someone has like a lot of conviction. If it's someone who historically has done very well, then it's positive. If it's someone who historically hasn't done very well, then it can really mean anything.
Cool. Let's close with prediction markets. You wrote an article called "The Prediction Market Paradox."
Yes.
Went viral. Argued that prediction markets do not always make markets more efficient, or at least that was my sense of the article. What's going on there?
I think prediction markets and their effect. So I'm generally pro markets, right? And I'm generally pro transparency in markets. And I think one thing prediction markets have done very well is kind of bring a lot of the the discourse around current events, current affairs, politics, sports, culture, whatever, into a quantifiable metric. And I think that in certain cases they can produce useful academic research and so on and so forth. I have a lot of very smart friends who work in prediction markets. So the bone I had to pick in that article was I felt that we were getting to a stage where prediction markets were basically being used to backdoor gambling to people who are not necessarily the best place to be gambling, right? And there are there are gambling laws for a reason. They're there to protect consumers. They're there to protect basically addicts. Gambling is an addiction for like a lot of people. Everyone agrees that we should have laws preventing the distribution. Everyone except like hardcore libertarians, I think, would agree that we need to have laws preventing the distribution of hard drugs. I think that makes for a better and more equitable society. Yeah. And the real worry there was in the kind of rush to be like, yes, let's financialize everything, markets work better on chain. I was like, let's take a step back. Let's look at what a lot of these markets are. A lot of prediction markets, you might hear about contracts about Taylor Swift's next song or whatever. Very, very low liquidity. It's very dubious that they have much kind of signaling or price action value whatsoever compared to Hims. Even on a down day, trades like tens, hundreds of millions of dollars a day.
Right.
Some of these contracts trade like $500 a day. So what value is being created there? And I had a bone to pick with certain
Hims related market on Kalshi. The question
was
will Novo Nordisk sue Hims by the end of 2025? And of course that went to zero. it sort of bounced around a little bit. But if you looked at the bottom left-hand corner, the volume never got above maybe 21 or $22,000.
Yeah,
Right,
exactly.
which gets traded every 5 seconds
Yeah.
in the stock market.
Yeah, exactly.
And so the argument there, it's not good signal for giving any sort of truth, any sort of aggregated information about what's actually going on here.
Exactly. So I mean, I do agree that markets, there's an amazing consensus mechanism that incentivize people to basically, if you have a well-researched opinion, you can go put your money where your mouth is and profit from that. And that's the ultimate incentive to bring this consensus. But it only works if there's a diversity of participants, if, all the participants have low frictions to trade, fees on, Kalshi very, very high right now. And it's not clear at all that, a lot of the discourse around Novo Nordisk is being expressed by, people going to trade on Kalshi because the volumes are so low, right? The liquidity is very low. Liquidity, I think, there's a guy I respect a lot called Agustin Lebron, who's like an exchange street trader. He wrote this fantastic article where it was like, the only time a financial market really works if you have a diversity of participants who are all kind of trading for different reasons, trading for different ways. And they basically come and, not everyone's trying to make a quick buck, right? Because if you have a market where everyone is just trying to make $5 in the next 30 minutes and then cash out, what happens is the guys who didn't make those $5, they get pissed and they leave, right? And then the remaining people, one of them has to lose money. Because if people are just trading against each other, one of them has to lose money. And eventually everyone leaves except one person who won all the money. And then no volumes happen in the market, right? So why does HIMS work in the market? You have bulls, you have bears, you have high frequency traders, you have long short hedge funds, you have fundamental hedge funds, you have value investors, you have HIMS themselves, right?
Right, which has been buying back shares.
Exactly, HIMS have been buying back shares. So the HIMS market exists, right, in some sense to allow a HIMS to raise capital and also to buy back their own shares so they can reduce the amount of dividend burden that they have. When they pay out a dividend, they don't have to pay out as much dividend if they own all the shares. And that fundamentally fulfills economic need for HIMS as a company. And it's very unclear what economic need is being fulfilled by prediction markets. So that was a bone I had to pick. I think they do have, there's good volume in sports. I think sports, gaming, gambling, whatever you want to call it, that's been around for a while. As long as it stays, relatively unregulated, I think that will continue to do well. I think elections will continue to do well. And I'm not saying all this, because I'm a genius. I'm saying this because we've had prediction markets for a very long time in the UK, actually. So Betfair is the UK's big prediction market. It's been there since about 2001. It has tons of volume on sports. Tons of volume on elections. When Brexit happened, it was like the place to look at for the probability of Brexit happening. And we've seen Betfair try and list any kind of contract, basically. And the only ones that really worked were sports and elections. And I think we're seeing the same in the US right now. And then I had some further bones to pick. I think I raised this with you as well, where, we were talking about the issue... with the elections.
The democracy situation.
The democracy situation, right? So markets work well when they have this sense of, we have lots and lots of people, and we're going to basically get a consensus of all their opinions and condense that into one thing, which we call the price. And the amount of weight everyone can give towards that opinion is governed by how much size they're willing to put on the trade, right? So if you take something like, let's say, gold markets, right? Gold markets are dominated by... in terms of like open interest and the amount of like real interest in the market, they're mostly dominated by big miners of gold, so like gold mining companies. And if gold mining companies want to go hedge a load of gold because they think they're going to mine a load of gold, that will drop the price of gold because there's going to be more supply. So they'll go and sell a load of gold futures, and that'll push the price of gold futures down. And that's a good thing because we have now anticipated this future demand in gold into the present day, and that's reflected in lower prices, right? Now, that works because they, as gold mining companies, can put a lot of size into the gold market. And you and I, maybe we haven't researched gold that much. Maybe I call the idea, I think gold's going to go up. If it's a low conviction bet, I'm not going to put a lot of size into that trade. And the amount of dollars I put into buying gold won't move the price of gold that much, right? Like, it won't change the price of it that much. It won't affect the underlying supply-demand balance that much. The issue with elections, right, and the democratic argument that I keep saying is, you could have, let's say, not to like, I've just moved to the US, right? So I'm not an expert on this, so please, like, forgive my inference, but my ignorance. But let's say, you have 50 people in Wyoming, let's say, right, and all these 50 people, They're in a very rural part of Wyoming, and they've just discovered Cauchy, and they see an election market out, right? Like, let's say next U.S. presidential election, and let's say these guys have $10 each, but there's 50 guys and girls who think that the market on the next U.S. presidential is mispriced. They go put their $10 each into this. They have $10 of price impact into the market. And then there's a billionaire in New York, and they see and they think, oh, this price is ridiculous. I'm going to buy yes on Democrats or Republicans. It doesn't really matter. Let's say it's just like somebody with $1 million of net worth, and they put $10,000 into the market, right? So the single person with a $10,000 impact has more consensus into this market than those 50 people in rural Wyoming who just put $10 in, because they had $500 of impact overall, whereas this New Yorker had $10,000. However, the people in Wyoming have 50 votes. So they have 50 times more ability to affect the outcome of the market, whereas the New Yorker has a single vote. Yeah. Right? In fact, the New Yorker's vote probably doesn't even matter, because I heard the Democrats always win in New York, right? And I don't know who wins in Wyoming. Maybe I should have chosen a swing state. Maybe that would have been a better example. But their votes really matter, right? And then you can't then say, oh, prediction markets are more accurate than exit polls, because you've just shown that the consensus and the weighting that's happening, that's not what's the same as a typical commodity market or a stock market, basically.
Thank you so much for being a part of Him's House. We'll let you go as we're at the top of the hour. This was fascinating. As Him sits under $16, I don't know where the bottom is. Hopefully soon. But thank you for giving another narrative to why there might be 45% short interest. Everyone has an opinion, and it's good to add this one to the mix. So thank you very much for being a part of Him's House.
Thanks for having me, and Hims to 100.